Welcome to a short video showing the calculation of a constant growth stock. Now, you've learned in the past that the valuation of any asset is simply the future cash benefits derived, discounted back at a rate that's commensurate with the risk associated with the ownership of this particular asset. Now, in class, I start with a simple lecture discussing a perfect asset. Now, I'm going to apologize for trying to draw with a mouse. It's not that easy. But I start with P0, that'd be the price today, and I tell them that an asset has the potential of going up. It could stay the same, or it could decline in value, and we'll call each one of these points here as P1. Now, most people, when they do purchase an asset, would like it to grow, but not all assets grow. The second point, and we'll call this G for growth, the second part of a perfect asset is that the asset generates cash flow back to the owner. When an asset has the potential of both growing and generating cash, I refer to those as a perfect asset, and the person purchasing such assets is a happy person. Now let's go back and look at the picture you have on the screen here. It's the same thing. It's a perfect asset of a stock, a little bit better than my drawing with paint, but I also tell students in finance that there's other things that can grow in this way. Generally real estate, if you purchase homes and rent them out, or small businesses, both have the possibility of increasing in value and generating cash flow. Just for an argument, a car does the opposite. They depreciate and take cash to continue to drive them, so that's why cars are not considered a good asset. Now, another thing that's important to understand is the calculation of a percent return. Now, if you look at your screen, I have the stock, and I put as price at 0 is $10, and price one period from now is $11. That would be considered the capital gains growth. Now, in order to calculate this calculation, we just take the last minus first divided by first. In this case, 11 minus 10 divided by 10 would be 1 divided by 10, shows us that the return is 10%. Now, look at the formula here in the center. What we just calculated was G. G was the price 1 year from now minus the price today divided by the price today. And D1 would be the dividends throughout the year. Generally, dividends are paid quarterly, divided by the P0. You add those together, and we have the return of a stock is nothing more than the percent return in dividends and growth. Now, if we look at the dividend discount model, which is just an algebraic rearrangement of this formula, and it's just a simple calculation using percent returns of the stock if it grows and the possible dividend it pays. You know, some dividends are not paid by certain companies. Therefore, the entire returns in capital gains. Usually these are smaller companies requiring capital to grow. Many of these companies are found in the New York Stock, the NASDAQ, the NASDAQ. Now, let's find the stock price given that the current dividend is $2 per share. Dividends are expected to grow at a rate of 6% in the foreseeable future, and the required rate of return is 12%. Now, using this formula, here it is again with the proper numbers placed where they belong. It's just basically a plug and chug. 2 times 1 plus the growth divided by RS minus the growth gives us the stock is $35.33. Now, one last important point. If G, or the growth, is greater than the required rate of return that you require, buy it. It's a good stock. In addition, if you do this calculation and you find that the stock price is $35.33, that's its value, and it's currently selling for something less than that, it's an undervalued stock, and it also should be purchased.